Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Let's do this. Kind of step through that a little bit quickly, but very important foundations to build on. So the first one that we want to look at, we're going to look at 5, and we'll do this in about the next 15, 20 minutes, and then we're going to go just into live charts for the remainder of the time. So again, nice split that we go through here. First one that we're going to look at is a category known as exhaustion reversal. Now, exhaustion reversal, before I jump into the details of this, simply refer to the fact that let me back up one step. If we are talking about trend reversals today, a prerequisite to a trend reversal is that you have an established trend in place in the first instance. So everything that we're going to talk about from this point out is based on the fact that we have and can identify the initial trend going into the reversal pattern. So if you have something that's just kind of, sidewinding, and you don't really have a clear trend in place, then we're not going to try to apply any of these patterns, because, and this is important, I always say, what's the story behind it? There are a blue million candlestick patterns and various types of price patterns, and if there's not a story behind it, if you can't tell me the why, then don't tell me the what. That's my view. I want to know the why, and the why isn't just because I got creative one night over a couple of espressos and came up with this new pattern. That's not sufficient. So let's talk about the why behind exhaustion reversal. Here's what it is. Number one, you have a trend in place. Let's say we have an uptrend. In an uptrend, who's in control, the buyers or the sellers? I'll pause. You can answer if you want, or you just think to yourself. In an uptrend, I guess, is stuff coming in the queue, and are you seeing stuff coming in the queue?
I'm not yet, so if someone would just throw an answer out there and let us know that it's not just 3 of us on the call.
You have to throw the right answer in. Somebody type in something in the queue. Okay, here we go. Thank you, James. At least, it'd be a shame for me to think that it's just 3 of us in here having a chat on our own and everybody else is
yeah, we can usually do that over a drink.
Yes, right. We've done it many times over the IED is correct.
All right, well, thank you. Those of you who sent in the response, yeah. In an uptrend, the buyers are in control. Okay, now this is important. This is not just, this is not minor stuff here. The buyers are in control. How do we know that? Higher highs, higher lows. They're advancing the price. This is the prerequisite for an exhaustion reversal. Now, in an uptrend that's going strong, we typically see volume. That is the strength of the trend, either increasing or holding its own. Now, an exhaustion reversal manifests itself in the midst of that trend. It appears as though the buyers are once again advancing the price. But, and here's where we put the asterisk before and after, but at some point, those buyers reach a point of exhaustion. That is, they make a big rush, and they can't hold it. So they are pulled back. Now, what does this look like? It looks like this. Boom, boom, boom. Green candle, green candle, green candle. Higher highs, higher lows. Typically, we look for the length of these candle bodies to be nice and long. That's not a must-have, but it's certainly an ideal. Now, some of you may not be terribly familiar with candlesticks, and so I don't want to assume too much, but I don't want to go back all the way to the beginning of candlesticks. But basically, if it's a long green body, what that means is there's a big difference between the open and the close. See, on a green body, the open is at the bottom of the body, and the close is at the top of the body. Now, if you've got a long green body, the simple definition is that there is a big distance between the open and the close, and it's a distance in favor of the buyers. Now, let's walk through the story. I've got a green candle. Buyers are in control. I've got a green candle. Buyers are in control. Now I look at this red candle. Now, really, the red is not that important. It's the shape of the candle. In fact, this body could be green, and it would have the same effect. It would have the same interpretation. Because here's what it is. If the body is real small, what that tells us is that the difference between the open and the close is not that far apart. But there's a more important piece to this. And by the way, for those of you who are familiar or might not be familiar with candles, this is known as the shooting star pattern. Now, I didn't come up with the name, so don't blame me for it. In fact, candlestick patterns have all kinds of very creative names, and I didn't come up with any of them. But this is called the shooting star. Now, let me ask you this. As we look at this, at some point during the day of this last candle, that third candle on there, at some point during the day, this candle looked like a big green candle. Now, I want to stop for a second. I want to make sure everybody understands that, appreciates that. Right now, it looks like a small red candle with a long top shadow. That line on top is called a shadow. But there was a point during the day that if I were to freeze frame trading activity, that candle would have looked like another long green candle. Now, I know that because the only way that I would have gotten this top shadow up here is if some point during the day, that price traded that high. See, we know that it opened here because on a red candle, the open is at the top and the close is at the bottom. So we know it opened at the top of the red body. And at some point, in order to get that top shadow, that would have been a green candle. All right, so what are we saying is happening? What's the story? Well, here's the story. The buyers, in the midst of an uptrend, the buyers had pushed this thing higher, but the sellers came in and drew a line in the sand and said this high and no higher, and they push it back down so that the close ends up very near the open. You've got indecision at that point, but it was indecision following a pushback by the sellers. Now, does that mean that the trend is reversing? Not yet, but it's the first sign. See, an exhaustion reversal always requires a confirmation. I'm going to say that again. This is a warning flag of a reversal. But what it's really telling you is that the window of opportunity is open for the other side to come in. But as traders, we need to make sure that they come in. So confirmation here would be to wait one more day, and if we get a lower close on a red candle, that's my confirmation. At that point, I would be a short seller or a put buyer or whatever bear market strategy you're using. This is called a shooting star. This is one type of exhaustion reversal. There are a number of them. At the top of an uptrend, this is my favorite. The same kind of thing happens at the bottom of a downtrend, and that would be called a hammer. So the two candle patterns that are our favorites as represented as exhaustion reversals are the shooting star and the hammer. Shooting star at the top of an uptrend, hammer at the bottom of a downtrend. All right. By the way, if you have any questions, go ahead and fire them in. I know I'm gonna walk through this a little bit more quickly, but just so you don't think that we're just kind of hit and run, and I know you know that we're not. Steve brings on a lot of great folks from a lot of different walks of trading, and I'm sure he'll be telling you about some of the folks coming up. But in between times, you can also join us if you want. On each slide you see is our website, which is promarketadvisors.com. And some of the stuff we do have is like a little bit more detail. If you want to go get a little bit further, get a little bit more information on some of these candle patterns, you're certainly welcome to jump over and visit us and take a look at whatever else we have as far as resources go. Okay, so that's number one. That's exhaustion reversal. Next one that we want to take a look at is an engulfing candle. Now, 2 of the 5 patterns are candlestick patterns. So don't think that we're going to be doing 5 different candlestick patterns. The first one that we just did, that was a candlestick pattern. This one is also a candlestick pattern. All right, this is called an engulfing candle. This is a very powerful one, by the way, because this actually has its own confirmation. Now, what do I mean by that? Well, you remember on the shooting star that I just went through, I said you have to wait one more day. because you need to make sure that that window of opportunity is going to be pounced on and the trend actually reverses. So exhaustion reversal is initial, but you have to wait for confirmation. Engulfing candle is confirmation in itself. So what does this look like? Here's what it looks like. I do this one in the other direction just so you don't think that these are all uptrend reversals. Okay. Remember, the prerequisite is you have to have a trend in place in order to have a reversal pattern. Could be an uptrend or a downtrend. Now in this one, we're looking at a downtrend in place. Long red candles, again, ideally we'd like to see the volume at least maintaining itself. Even better if the volume is increasing. What are we looking at on a downtrend? By definition, the technical definition of a downtrend is lower highs, lower lows. So, you know, I really like it when I can just put a checklist on something. Lower highs, lower lows, red candles, volume holding its own. You know, I don't like to have to interpret too much stuff. I'm not saying you could program it because, in fact, just the opposite. This doesn't really lend itself real well to programming. I know there's going to be at least a half dozen, on this call, there's at least a half a dozen engineers and technical types who will vehemently disagree with me on that, but that's all right. We can do that over a cup of coffee sometime. But anyways, you're looking at this lower highs, lower lows, red candles, downtrend. Now, here's what sets up the engulfing candle. This particular one that we're looking at is called a bullish engulfing candle, but you can have the exact same thing at the top of an uptrend, and that's called a bearish engulfing candle. All right, let's talk about the bullish engulfing candle. Here's what it is. By definition, it is simply a green candle whose body fully engulfs the previous day's red candle. There it is. The green candle fully engulfs the previous day's red. All right? Now, how did that happen? Well, here's how it happened. On a downtrend, you notice that on this red candle, the open is right here, and the close is right here. So the stock or the price, whatever it is you're looking at, could be the currency pair, closed at the bottom of the red candle. Now, on the next day, the bottom of the green candle is even lower. How does that happen? The only way that happens is for the price to gap down overnight. So the open of the green candle has gapped lower than the close of the previous red candle. That is what sets up for us the engulfing candle. Now, if we were to let's just stop right there. At 9:30, we do a few trades, boom, we freeze frame it. If I were to ask you, what is the sentiment of that trading activity, would you say bullish or bearish? Now, again, I just stop it at 9:30. We're just going to let it open. Is that bullish or bearish? Well, I'd hope you'd recognize that it's bearish and very bearish. Why? Well, we've got a downtrend in place, and in the middle of this downtrend, it gaps down. Doesn't get a whole lot more bearish than that. So we know that clearly the sellers are in control. But that's the big caveat with all of these reversal patterns. But from that point on, we start seeing the buyers come in, and they get stronger and stronger and stronger, such that by the end of the day, the buyers are closing that price higher than where it started the previous day. So this is a strong reversal pattern that shows that at the beginning, the initial trend is still very much in place, but they slam on the brakes, they turn around and do a 180, and they move it forward in the other direction with enthusiasm. All right, I thought maybe Shawn, that was you.
Nope, that wasn't me. I'm not sure what that is. Sounds like a cuckoo clock.
Yeah, I think we might get a little chow. Right, that's fine. Okay, so as I said, this one is self-confirming, meaning when you see this pattern form, it is perfectly acceptable to take on a new long position, buy calls, buy if it's a stock or an ETF, buy that, take a new bull position at the end of the day. Typically, last 10 or 15 minutes, as you see this candle taking shape, it's okay to go ahead and take a position, or just go ahead and enter into position at the beginning of the next day. The point is, you do not need to wait another day for confirmation. This is its own confirmation, is the engulfing candle. So this is the bullish engulfing candle that we're looking at. Again, at the top of an uptrend, you can see the same thing happening with a bearish engulfing candle. So that's number 2. I'm going to make sure, I'm probably looking at 5 to 7 more minutes yet before we go to live charts. So I think we're making good pace here. The next one is actually a price pattern. So we're not focusing now on the candles. We're focusing on the shape of the price. Now, let me just catch a question here real quick. James is asking, when entering after an engulfing candle, where would you put your stop loss? James, that's an excellent question. I appreciate you asking that. There are a couple ways that you can do this, James. Typically, if you are somebody that can only look at the charts at the end of the day, then where you would put your stop loss is below. In fact, let me go back one step here. There we go. Okay, down here I would put it below the low of the engulfing day. So down here, this is the low. I would put it just below the low of the engulfing day. That would be your most generous place. And you notice that's a pretty big risk per share. See, you'd be buying it somewhere up here, and you'd be putting your stop down there. So I understand that by having that much room before you hit your stop means you're probably going to be taking a smaller position. But that would be your most generous stop, is to put it below the low of the engulfing candle. Now, if you're somebody that has the ability to look at a chart intraday, and typically for intraday, I would not go down any tighter than 15 minutes. 15 to 30 minutes on an intraday basis is a good number. Many times, the intraday chart will show you an intermediate level support. See, you could look at the intraday chart and see how this green candle was formed. And a lot of times, a 15-minute chart or a 30-minute chart will give you an intraday support that typically is a lot higher. Might be somewhere around the middle of the candle body. That will give you a little bit tighter stop, which means you get to trade a little bit larger position size. And a lot of times those intermediate support levels do hold up pretty well on an engulfing candle, because you would expect that the reversal would move it then in the direction of the engulfing candle. But recognize that there are a lot of people that don't have the ability to look at an intraday chart and pay attention to what's going on, at 10 o'clock, at 12 o'clock, at 2 o'clock. In that instance, the typical stop would be just below the low. Hopefully that answers that question okay for you. Thank you. All right, let's go back now to the next one, which is the M reversal, or the double top. And again, all of these reversals have a companion that is in the opposite direction. So the companion to a double top or an M reversal would be a double bottom or a W reversal. Yes, sometimes traders aren't the most creative people, but nevertheless, that's how it looks. Let's look at the M reversal or the double top. Okay, so let's walk through this. And we have an uptrend in place. Stock is moving, the price is moving higher. Then we see the price advance. Now, at this point, we don't know that it's forming the M or the double top. What we know is it's moving higher. And it hits a peak, wherever that might be, and starts to move back down. Then it moves up again and reaches a secondary peak that is approximately the same level as the first peak. Now, this is the first point at which you would begin to suspect that this may be forming an M reversal. See, as it's coming down this part, there's no reason to think that it's an M reversal. I mean, for all you know, it might have already done its trend reversal and might just be on its way down to about nothing. So it's not until we hit the second peak, and this is important. The second peak should be approximately equal to the first peak. Also, we don't need perfect symmetry between this side of the M and this side of the M, but we do like to see some level of symmetry. And what I mean by that is, if from here to here is about 2 weeks, then we like to see from here to here be about 2 weeks. In other words, if from this part of the M to the middle is 2 weeks, you kind of lose the validity of this pattern if from the middle to the next part of the M it's 2 months. Now, that's, again, you got a lot of flexibility there, but the more symmetry that you have, the better. So, again, we see a secondary peak that is approximately the same level as the first peak. Now, here's where rubber hits the road. After the secondary peak, it drops. Now, you see this dark green line. This is called the support line for the M reversal. This pattern is not considered to be complete. In other words, this pattern comes into effect, it comes into play at the point that the price breaks the support following the formation of the M. Hesitate. So the M is formed, the double top is formed, but we don't trade this one until the price breaks this key line. This line right here is the key to trading this pattern. And then it's simply a matter of, if it breaks below that line, at that point, take a new short position or buy puts, again, whatever bear position you want to take, and protect yourself above that line. All right. Wow, Shawn, I always have more stuff to talk about than time to talk about it, but I'm down to the last two, and I promise I will finish up here in just a minute.
I think you got a good pace going, though.
All right. Hopefully so. Number 4 is moving average support and resistance. That's what S&R stands for, moving average support and resistance. And this is a pretty easy one. This is simply using key moving averages as floors and ceilings. And these work particularly well whenever you have a good channel going, as we see right here. Now, the two moving averages that we like to focus on are the 50-day simple and the 200-day simple. And I'll tell you why. You know, like I said, don't just listen. If I ever tell you about something and I don't tell you the why, please call me on it. Feel free to ask, because there's always a why behind it. So why 50, why 200? Very simply this. 50-day simple moving average is approximately the number of trading days in a quarter. Can anyone tell me what happens on a quarterly basis? If you said earnings, if you said SEC reports, if you said financial filings, you got it right. On anything that's traded publicly, quarterly is important because of the filings and the reports. So what I'm going to be looking for is I'm going to be looking for a moving average that tends to smooth out the quarter-to-quarter volatility. And the 50-day moving average does a real nice job of that. So that's why I use the 50. How about the 200? What's important about the 200? Well, say the 200 is getting pretty close to approximately the number of trading days in a year. It'd be closer to 250, but probably more important than that is the 200-day moving average of the 800-pound gorilla. You know, you might not agree with it, you might not like it, but you better not ignore it. It's the one that everybody watches, and a lot of people trade around it. So it's pretty important for you to pay attention to it also. So in this example that I just grabbed here, and this is a recent example, what we're looking at here is just the red line is 200-day simple moving average. The green line is the 50-day simple moving average. Now, you see how very often these will identify themselves as support and resistance. Now, you say, well, okay, Rick, that's great, but look here, you know, that one was resistance, that one was resistance, but that one didn't hold. So what's up with that? You know, how do you know? Well, here's just a very simple way that I like to use it. I like to watch, not to see if it's just going to punch through or bounce right up. but I like it when it tries to get through and can't. So while this one's a good one, but let's face it, it only touched it once and fell. This one's a good one, but it only touched it once and fell. This one right here is how I like to use this reversal pattern. I love it when I see a price go up to a moving average and it can't get through. And then it tries it again and it can't get through, and again and again and again. Look at this. A week, 5 days in a row, this price bumped up against the moving average, and for all its best efforts, it could not get through. That is how I like to use moving average support and resistance as a reversal indicator. Now notice I'm not looking at the candles. I could look at the candles. I could say, well, okay, is that an engulfing pattern? Is that a doji? Is that a shooting star? And it's not bad to do that. You know, in fact, this one right here, those of you that know candle patterns, that's a really nice spinning top. And it's a spinning top after a real sharp jump here. So, you know, you could combine the candle patterns with the moving average. But listen, if I see you walk into a wall, and then you back away and walk into a wall again, and then you back away and walk into a wall again, and you do that 5 times, well, first of all, I'm going to question your sanity. But the next thing I'm going to think is you're not getting through that wall. It's the same thing with price. If price goes up against a wall and goes up and up and up and up and 5, 6, 8, 10 days in a row, it tries to get past that resistance and it can't. Well, my money's going to be on it's going the other way.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.